Hi guys, do you really want to know what's happening in the markets or expected to happen in the markets in the coming week? If yes, you're in the right place. Join me, Vijay Bhambwani, as we go into a weekly market outlook for the week December 1 to December 4, with November 30th being a holiday on account of Guru Nanak Jayanti. So, first we begin with a brief recap of what really happened in the markets. Unlike other weeks, this week, on the week gone by on Friday, saw a little bit of a risk off as the markets were somewhat subdued. Now, in the previous weekend's video, I had covered the aspect why. I was expecting a long weekend thanks to Monday, which is 30th of November being a holiday due to Guru Nanak Jayanti, which would basically weigh on the risk-taking capability of the market participants. And on Wednesday, when the announcement of peak margins were basically released by SEBI and the exchanges, it led to a flurry of unwinding. You see, from 1st of December, it will take you somewhat more of capital outlay to be able to trade in options and futures. We'll basically cover this in greater detail towards the end of this video, so stick around with me. And as you can see on your screen, a roundup of the markets, and there was a risk off in the undertone on Friday, and the Nifty gained 0.85% on a week-on-week basis. The Bank Nifty gained 1.28%. Gold and silver fell because safe haven buying actually went out in spite of the fact that the US dollar index, the DXY, fell. Crude oil and natural gas both went up marginally more than 7.5% each. Now, this is a negative factor. I have been saying in my previous videos that a falling dollar is good for emerging markets. Falling crude and natural gas prices are also good for emerging markets, especially India, because we are import dependent. Right? So one reason why the Nifty and the Bank Nifty did not rise as much as the preceding weeks was because energy, which is crude oil and natural gas, were high. The US dollar index, the USD INR, which is the United States dollar versus the Indian rupee, went up by 0.03%, even though the DXY went down, which means the Indian rupee actually lost a little bit in relative comparison to the global basket of currencies against the dollar. The 10-year benchmark bond yields, which is the sovereign bond yield, went up from 5.88% in the week before last to 5.90% in the previous week. The market-wide position limits as of last weekend were 37.23%, and they fell to 17.62%, which is very natural in a week that one sees expiry of the derivatives series, both weekly and monthly. But this time's decline in MWPL has been somewhat remarkable, has been pronounced, and therefore traders need to keep a keen eye on this aspect of the market. Hey, if you join me on my social media pages, contact coordinates will come up towards the fag end of the video. You can watch these statistical data points that I update on my social media pages every evening post market, and you can update yourself with as the figures unfold on a day-on-day basis. Now, on your screen coming up is a chart of the MWPL, which shows a dramatic decline after expiry, especially the margin escalation point of SEBI, which comes into effect from 1st of December 2020. Well, the MWPL is expected to rise in the coming weeks. Whether it will go to 38 or 39% or higher like it has in the recent past remains to be seen. Now, this is an aspect that you'll have to really keep your ears to the ground and keep watching for these signs. Coming up on your screen now is the chart of the basis. As you can see, both the Nifty 50 and the Bank Nifty have seen positive basis, because the prompt month future is now the December series rather than the November. There's a full month of trading ahead out there. The cost of carry has been factored in, and more importantly, because the markets have crossed new highs, the bears have been squeezed, and therefore they have been forced to repurchase some of their short positions, and the basis therefore has expanded. Now, this metric will be a good indicator of future trends, which I keep putting on my social media pages, my contact coordinates coming up ahead. What you are also seeing is that volumes of both the indices and the stock futures have eased off, which means the rally which was seen last week was on relatively lower volumes. Now, these are aspects that you need to keep watching in the week ahead. Now, crude oil and natural gas prices are also another indicator. As long as these energy prices keep going up, they are expected to trigger higher inflation and therefore exert downward pressure on the Nifty and the Bank Nifty. So keep watching this space, especially if you are a Nifty or a Bank Nifty option trader also, both option writers as well as option buyers, because both the margin and crude and natural gas prices are likely to be hostile data points for you. Now we come to the 10-year benchmark bond yield. As I have told you in the past, the bond market is the fountainhead of all source of money supply, and this is the area that basically determines the Bank Nifty more than the Nifty 50 and the large banking stocks, for the simple reason that the largest holders of Government of India bonds are the banking institutions, and what happens to bond prices and therefore the bond yields basically impacts your Nifty and Bank Nifty. So coming up on your screen, as you can see, the 10-year benchmark bond yield chart, it's gone up from 5.88% last week to 5.90%. And the deficits have gone up, which is what is basically triggering the government to issue more bonds, which means the market expects the government to come out with increasing number of bond issues. The LTROs, repo operations of the government, may not be as frequent as anticipated earlier, and I talked to a couple of bond market participants. They expressed these fears. Rising yields may trigger some fund flows into equity markets, because so far people were seeking safe haven buying in bonds, which is tapering off as of now. The fact that gold and silver prices are also lower tells you that the market is in a risk-on mode, relatively speaking. Otherwise, they should have been buying more of gold and silver, as also bonds, in which case the bond yield should have actually fallen. So watch the bond yields very, very closely in the coming weeks. And I, of course, will be updating the same in my weekly market outlook videos, of course. Especially if you are a Bank Nifty and banking stocks trader or investor, this is one area of markets that you need to watch very keenly. Let's now come to the US dollar index, the DXY. It managed to rise only on 1 out of 5 trading sessions, as you can see on the chart on your screen, and it managed to fall 0.65% on a week-on-week basis. The closest swing low support is at 91.72, which was made on 1st of September 2020, which you can see on the chart on your screen. Should it remain below this level, I think further downsides might just open up. The DXY is, as it is trading below its 25-period exponential moving average, it's making lower tops and lower bottoms formations, which is basically an indication of weakness. In my humble opinion, I think the falling DXY has been a saving grace, and that is one large reason why the Nifty and the Bank Nifty closed the previous week in positive. In spite of the fact that crude oil and natural gas were higher, it was the weak dollar that basically saved the bulls of the blushes last week. Keep watching this index in the coming week ahead. And I think what we need to basically check out for is fears of imported inflation, because oil and gas are basically multiplier commodities. If oil prices continue to remain higher, it basically impacts prices of everything: fruits, vegetables, transport, conveyance, milk, eggs, etc., grains, etc. So if the dollar Dixie or the dollar index is to go up in conjunction with the crude oil and natural gas, that will be another pressure point for the domestic equity market. So you need to watch this area of the market very keenly. Now, last week I advocated expected support and resistance levels at 91.05 and 93.70 respectively, and these levels held fairly accurately. In the coming week, I expected and estimated, I emphasize on the word estimated here, I expect the estimated range to be between 93.10 on the upside and 90.5 on the downside. Now, basically, you will keep an eye on the dollar index, especially if you're also participating in the commodities market. Let's now go to the Bank Nifty, the second most favored counter on the NSE after the Nifty 50. Now, as you can see on your chart on your screen, it rose on 3 out of 5 trading sessions, although the declining days were a little more prominent, as the candle size can indicate to you right away. And this index gained 1.28% on a week-on-week basis. The up move has started showing signs of a mild slowdown, and last weekend in my video I had raised a red flag on the negative divergence between the price and the RSI, which basically was justified by the market in the week gone by. Now, that kept a lid or a limit on the upside potential of the Bank Nifty. For the bulls to regain their control completely over the markets and basically overpower the bears, the index must trade above the intraday high made on Wednesday, for the simple reason that Wednesday basically logged a very large prominent bearish candle, as you can see on your screen. And remaining above the high made on that bearish candle will in no uncertain terms lay out the roadmap in favor of the bulls. And that level happens to be 30,198 in the Bank Nifty in the spot segment. In the week before last, the Bank Nifty was at number 3 of the most volatile list. Here again, this list is something that I update on my social media accounts late evening post-market. You can connect with me and check out these data points as and when they unfold. But last week, the Bank Nifty fell to number 4, which means it moved down 1 notch in terms of volatility. It is not exactly a good enough reason to celebrate, because there were stocks that have gained in volatility above the Bank Nifty rather than the Nifty, the Bank Nifty actually falling per se. Also remember that the peak margin issue is likely to make the markets a little more cautious, which means the traded turnover both on the Bank Nifty and the Nifty 50, including the overall market, especially in the futures segment, might just move down a little, might just decrease a little. In the scenario where volumes compress a little, the bid and offer spread, the difference between the buy and the sell price on your F5 screen can actually widen. That is called impact cost. Now, if the impact cost, which is the incremental cost between buying one lot and the other, goes up because of poor liquidity, that can actually hit both futures and options traders adversely. So this is another area where you need to be very careful about. In the week gone by, I had advocated an anticipated level of 30,900 on the upside and 27,550 on the downside, which held perfectly well. In the coming week ahead, I expect an estimated, I emphasize the word estimated here, a range between 31,250 on the upside and 27,975 on the downside. We now come to the Nifty, the most liquid counter out there on the exchanges and obviously the most favored for high frequency, swing, intraday and positional traders. So the Nifty 50 index rose on 3 out of 5 trading sessions, exactly like the Bank Nifty, although it underperformed or continued to underperform, I would say, the Bank Nifty by rising only 0.85% on a week-on-week basis. I mentioned in my previous week's video that this underperform was likely to continue, and the bulls will now have to keep the Nifty spot trading above the Wednesday high, which is the 25th of November, exactly like the Bank Nifty. Now, both these indices, the Nifty and the Bank Nifty, saw a huge amount of selling on Wednesday after the peak margin system regime was announced. And the Wednesday's intraday high of a very large bearish candle, as you can see on your screen, is at 13,415 in the spot segment. You'll have to keep the index above this level to be able to have a clear dominant position for the bulls over the bears. In the week before last, the Nifty was at number 10 of the most volatile list on the NSE, and in the week gone by, it rose by one notch to number 10. Now, this is a data which I update on my social media every day, and maybe you'd like to connect with me out there and watch as these figures are released on a day-on-day basis. I expect the beta or the statistical volatility to basically go up in the coming week. The reason being the same peak margin system and the possibility of lower volumes and therefore a wider bid and offer spread between the buyers and sellers, as also higher impact cost, the price differential that you would have to pay to buy or sell increasing number of lots. So if the impact cost goes up, and this is of particular interest to statistical and systems traders like me, who create their own systems based trading buy and sell triggers, you'll have to tweak your trading systems, my dear friends, to be able to accommodate the higher impact cost, if any, which we will see on our screens coming next week. Now, in the week before last, I advocated an estimated range between 13,300 on the upside and 12,425 on the downside, which held. And in the coming week, I expect the estimated, I emphasize on the word estimated here, the range between 13,400 on the upside and 12,550 on the downside. Continue to trade light in the market and watch the bid and offer spreads very, very carefully, because therein will lie your profitability or lack of it thereof. Now, let me come to the most awaited and the kind of feedback that I receive from friends on my social media pages. Top high beta stocks which you can trade with small exposure but large price moves, and top 5 low beta stocks which you can trade with high exposure but with very small price mobility. The risk reward, the risk appetite and the trading systems that you will need to tackle both these strategies are different. Therefore, we split the list into high beta and low beta. Now, here we go. As you can see on your screen, the high beta, high impetus stocks which you will trade with smaller exposure but larger price moves is led by TVS Motors at number 1, number 2 Exide Industries, number 3 Tata Consumer, number 4 Manappuram Finance, number 5 Voltas. The low beta, low impetus stocks list is led by HDFC Life at number 1, number 2 being Larsen & Toubro, number 3 ICICI Prudential Life Insurance, number 4 Maruti, and number 5 SBI. Now, of course, this list is not ironclad. maybe some development can occur in any of these or most of these even stocks. Some news release, etc., could see one stock move from one list to the other. Of course, this is something that we traders have to learn to live with, uncertainty in the market as the price action changes on day basis. And like I told you, what you need to watch out for, this is the key point of the video of the week. What you need to watch out for is the impact of the peak margin issues. Now, this will basically mean that your capital outlay as a trader in the futures and options space will go up, which means the return on your capital will possibly come down. You will need more and more money to be able to remain in the business and keep trading like you used to. Remember, the exchanges will now charge you margins at your peak exposure. Even if the next trade is smaller than the large trade, the margin blocked will be of the large trade itself. And it will be released not when you square up that trade, but after the day is over. Now, it actually has a lot of implications for both options and futures traders. Option writers and even buyers for that matter, intraday players will have a certain amount of sacrifice to make in terms of profitability. Your profitability has a risk of coming down a little. For those people who feel that this will encourage trading more and more in the cash segment rather than the F&O segment, let me remind you that the STT in the cash segment is significantly higher than the F&O space, which means your profitability can go out of the window if you are not very careful. Now, on this cautious note, let me take you through my contact coordinates of social media pages that I have. I would love it if you can make a connection and start conversations with me. I'll look forward to that. Hey, in the comment section, do let me know what you think about this video. Help me reach out to fellow like-minded traders by recommending my video to your family and friends if you liked what you saw. And I hope you have a very, very profitable week ahead. Till we meet again in my coming video in the coming week for the weekly market outlook. Of course, expect some midweek videos on more trading tools, book reviews, and tips and tricks of being better traders. So take very good care of your investments and trades. Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Thank you for watching me. Bye-bye.